What if you could build a financial engine that pays you more and more every year without you having to lift a finger? It's not a fantasy. It's the power of dividend growth investing. For so many people, the stock market feels like a casino. It seems risky, unpredictable, and frankly, rigged for the house to win. But what if I told you there's a strategy that flips that script entirely? It's a method that isn't about wild bets or trying to time the market. It's about owning small pieces of fantastic businesses that literally share their profits with you. Today, I'm pulling back the curtain on this powerful strategy. Forget the confusing jargon and complicated charts. I'm going to give you a step-by-step blueprint to build your own profitable dividend portfolio, starting right now. We'll cover why this approach has stood the test of time and exactly how you can put it into action to create a passive income stream that actually grows by itself. So, what is dividend growth investing? At its heart, it's beautifully simple. You invest in stable, established companies that not only pay you a slice of their profits, called dividends, but also have a long proven history of increasing those payments year after year. Think of it like buying a little money machine that sends you cash. But with this strategy, that machine gets a tune-up every single year, so it sends you even more cash. It's that consistent growth that makes all the difference. The real magic, though, is compounding. You've probably heard of it, but this is where it comes to life. It's like a snowball rolling down a hill. When you get a dividend payment, you have a choice. You can pocket the cash, or you can reinvest it to buy more shares. When you reinvest, your next dividend payment is automatically bigger because you own more of the company. Those new shares then start earning their own dividends, which you can use to buy even more shares. See the cycle? It's slow at first, but over time, that tiny snowball can grow into an avalanche of passive income. Historically, reinvested dividends have been a massive driver of the stock market's total returns. In fact, a huge chunk of the S&P 500's overall gains over the long haul has come from dividends and the power of compounding them. This really drives home a crucial point. Investing isn't just about hoping the stock price goes up. And here's something you can't put a price on: peace of mind. Markets will always have their ups and downs. During a downturn, watching your portfolio's value drop can be absolutely terrifying. But dividend growth investors have a secret weapon: cash flow. While everyone else is panicking, your portfolio is still paying you. That consistent income gives you the stability and the confidence to not sell at the worst possible time. You're focused on the long-term cash your portfolio is generating, not the chaotic short-term noise of the market. Okay, now how do you actually build one of these dividend machines? It's not rocket science. It's a disciplined, repeatable process, and here's your 3-step blueprint. Step 1. Finding your dividend champions. The goal here isn't just to find any company paying a dividend. We're looking for world-class businesses that can keep paying and growing those dividends for decades. First, you look for a proven track record. The gold standard is a list of companies known as the Dividend Aristocrats. These are S&P 500 companies that have increased their dividend for at least 25 consecutive years. Think about that for a second. These businesses have powered through recessions, market crashes, and global crises, and through it all, they kept giving their shareholders a raise. That kind of track record screams durable business. Next, you have to check for dividend safety. A classic rookie mistake is falling for a yield trap, a stock with a ridiculously high dividend that looks too good to be true. It almost always is. An unusually high yield is often a massive red flag that the company is in trouble and that dividend is about to get cut. To sidestep this, we use a simple metric: the payout ratio. This just tells you what percentage of a company's profits is being paid out as dividends. For most healthy companies, a payout ratio between 30% and 60% is the sweet spot. It shows they're serious about rewarding shareholders, but are also keeping enough cash to reinvest in their own growth. If you see a ratio creeping above 75% or 80%, be careful. That could mean the dividend is unsustainable. Step 2. Building a resilient and diversified portfolio. Once you know how to spot a great stock, the next rule is simple: don't put all your eggs in one basket. Diversification is your #1 defense against something going wrong with a single company or an entire industry. You want to own a team of these dividend champions from different parts of the economy. Think healthcare, technology, consumer goods, utilities, and so on. By spreading your money out, you lower your risk. If one sector has a rough year, another might be soaring, which helps smooth out your returns and protect your income stream. If picking individual stocks sounds a bit overwhelming, dividend ETFs, exchange-traded funds, are a brilliant solution. Funds like the Vanguard Dividend Appreciation ETF, VIG, or the Schwab US Dividend Equity ETF, SCHD, instantly give you a diversified portfolio filled with high-quality dividend-growing companies. Step 3. Activating Autopilot, the magic of reinvestment. This last step is where you truly put the snowball effect on autopilot. It's called a Dividend Reinvestment Plan, or DRIP, and it's your best friend. Almost every brokerage account lets you turn on DRIPS with a single click. When you do, every dividend you receive is automatically used to buy more shares, or even tiny fractions of a share of the stock or fund that paid it. You are literally earning returns on your returns without any extra effort. This automated process is what transforms your portfolio from a simple investment into a self-fueling engine for building wealth. Over the long run, an investor who reinvests their dividends can easily end up with a portfolio worth dramatically more than someone who just spends the dividend cash. All right, quick pause. We just covered the core 3 steps to building your portfolio. If you're finding this blueprint helpful, do me a quick favor and hit that subscribe button. I put out videos just like this one to help you build wealth and reach financial freedom, and I'd love to have you along for the ride. So what does this look like in the real world? Let's run the numbers, because seeing this in action is where it really clicks. Meet Alex. She starts with $10,000 and invests it in a basket of reliable dividend growth stocks with an average starting yield of 3%. That means in her first year, she earns about $300 in dividends. $300 isn't a fortune, but Alex reinvests it. Now her portfolio is worth $10,300. And every year, her companies raise their dividends by an average of 7%. Nothing flashy, just steady, proven growth. By year 5, her portfolio has grown to about $12,500, and her annual dividend income has risen to roughly $420 per year. That's a 4.2% yield on her original $10,000, up from 3%. After a decade of reinvesting in steady growth, Alex's portfolio is now worth around $17,000. Her yearly dividends, close to $600. Her yield on cost, meaning how much income she earns on her original investment, is now 6%. By year 15, her portfolio has crossed $23,000. Her annual dividend income has climbed to nearly $850. That's 8.5% yield on cost, nearly triple her starting rate. Now comes the magic of compounding. After 20 years, Alex's $10,000 has snowballed to roughly $31,000 purely through reinvested dividends and growth. Her annual dividends? A whopping $1,300 per year. That's a 13% yield on cost. Alex didn't trade constantly. She didn't chase the next hot stock or try to time the market. She just kept owning great businesses and letting the dividend snowball roll. 20 years later, she's built a financial engine that pays her a growing salary, completely passively. That's the real power of dividend growth investing. Look, the steps are simple, but the hardest part isn't the what, it's how you think. Dividend growth investing is a marathon, not a sprint. The real life-changing rewards don't show up in a month or a year. They show up over decades. You have to train yourself to ignore the daily market noise. The news will be dramatic and stock prices will have wild swings, but the dividends from high-quality companies are known for their stability. Your focus should always be on your growing income stream, not the flickering stock prices. Think of yourself as a business owner, not a stock trader. Your job is to grow the cash flow that your business, your portfolio, produces each year. Patience and consistency are your superpowers. Just keep investing what you can, keep reinvesting those dividends, and trust the process. The get-rich-quick schemes almost never work, but the get wealthy slowly and surely plan, that's the one that has stood the test of time. So let's bring it all home. It boils down to this. Understand the incredible power of the dividend snowball, then follow the blueprint. Find quality companies with a history of raising their dividends, spread your bets by diversifying, and, most importantly, always reinvest those dividends to let compounding work its magic for you. Thanks for hanging out with me today. If this video helped you understand the power of dividend growth investing, give it a thumbs up and make sure you're subscribed for more guides on your financial journey. Now go start building your dividend machine.